Hello everyone, welcome back to Gold Rush Reporter, your go-to source for clear, no-nonsense analysis on gold and silver. Today, we're diving deep into one of the most intense moments in the precious metals markets we've seen this year. If you think silver and gold are just moving randomly, think again. There are serious structural forces at work, and it's critical you understand them if you want to make smart moves. Let's start with a shocking event that set off ripples through the markets. Recently, the CME Group shut down its precious metals servers for 12 hours, citing an overheating server. It sounds minor, but here's the kicker. This only affected precious metals. Nothing else, forex, equities, interest rates, was touched. And this happened in the middle of the night, during a period of very low trading volume. Coincidence? That's for you to decide. But for silver traders, it came at the exact moment of a massive delivery request. $400 million worth of silver standing for delivery. No cash settlement. That's huge. And yet, the system paused. Why does this matter? The COMEX was designed as a price-setting mechanism, not a physical delivery system. It's built on the assumption that almost no one will demand physical metal. That assumption has been breaking down. Now, we're seeing sovereign buyers, industrial players, and large private entities aggressively standing for delivery. The traditional paper game of futures and leverage is being challenged by actual physical demand. Take silver, for example. Earlier this year, it broke past $54 in Asia, while the US markets were frozen. The result? Supply and delivery systems are showing real cracks. Registered inventories on both COMEX and LBMA are dropping. LBMA even extended bar transfers from T+1 to T+8 weeks due to manpower and trucking shortages. If gold and silver were banks, this is exactly what a slow-motion bank run looks like. For investors, here's the takeaway. The old system of trust in Western price discovery is under strain. Exchanges pausing, deliveries delayed, and physical demand overwhelming paper markets are all signs of a structural shift, not a temporary blip. And make no mistake, the US government has reclassified silver as a critical mineral, putting a strategic floor underneath it. That means industrial and national security demand will only grow. In short, this is not about speculation. It's about real, structural pressure on the metals markets. Physical demand is challenging the paper system, and those paying attention are already positioned for what's coming next. We looked at how recent events exposed cracks in the Western precious metal system. Now, let's dive deeper into the mechanics behind these moves and why this is so critical for gold and silver investors. The first thing to understand is physical demand versus paper manipulation. For decades, silver and gold traded mostly as paper contracts. Almost no one ever stood for physical delivery. That's changed. In recent months, we've seen massive standing deliveries. During the December cycle alone, COMEX reported 23,970 gold contracts. That's nearly 2.4 million ounces, and 8,305 silver contracts, or over 41 million ounces, standing for delivery. These numbers are unprecedented. What's striking is who's driving this. Open interest is extremely low, meaning hedge funds, momentum traders, and retail speculators aren't heavily involved. The buyers are deep-pocketed entities, sovereign nations, state-aligned industrial buyers, and a handful of ultra-large private actors. One silver delivery alone totaled $2 billion. That's not casual speculation. That's strategic accumulation. Now, consider the timing of these events. Silver broke $54 in Asia the night the CME servers overheated. Registered inventories on COMEX and LBMA have been shrinking quietly. LBMA has delayed bar transfers to 8 weeks. The system is straining under real demand. This is more than market volatility. This is structural stress in the pricing system. Meanwhile, macroeconomic pressures are stacking up. The US has reclassified silver as a critical mineral, signaling strategic importance. Interest rates are being manipulated indirectly. The Fed can't fight inflation without risking the economy, so they're choosing to tolerate inflation while quietly supporting markets with lower rates and balance sheet actions. Real inflation, according to honest measures, is closer to double digits, far above the official CPI numbers. This combination of physical demand, strategic positioning, and macroeconomic pressure creates a unique scenario. The Western paper pricing system is under siege. Every exchange outage, delayed delivery, or inventory drain erodes trust. When trust in price discovery collapses, markets start shifting towards centers perceived as fair and reliable. That's why Shanghai's influence is growing. Contracts there are backed by real, serial numbered bars. You pay, you get metal, no rehypothecation. For investors, this is huge. The market is sending a clear signal. Those who control physical supply are quietly accumulating while the broader public is distracted by equities and AI hype. Silver and gold are no longer just assets. They're strategic instruments in a market realignment. We explored how physical demand is straining the Western precious metal system and why sovereign and industrial buyers are quietly taking control. Now let's focus on scarcity, ratios, and real market signals that every serious investor needs to understand. First, the gold to silver ratio. Historically, gold trades roughly 45 times the value of silver. Today, that ratio is approaching extremes because silver is being mined at 7-1, yet its price still lags far behind historical averages. This disconnect is unsustainable. Scarcity in silver is accelerating due to mining depletion. Major silver deposits have been exploited for decades. New production can't keep up. Industrial demand. Silver is essential in electronics, solar panels, and advanced technology. Strategic accumulation. Governments and large private entities are standing for delivery in massive amounts, removing metal from circulation. The result? Premiums are rising in Asia, especially Shanghai, where silver contracts are backed by actual bars. Compare this to COMEX or LBMA, where paper contracts dominate and rehypothecation is common. The market is rewarding real ownership, and as confidence in Western exchanges erodes, capital shifts to reliable physical-backed centers. Now, let's talk about retail participation, or lack thereof. Retail investors are heavily leveraged in equities, AI hype, and options. They're distracted and overexposed, leaving metals to the serious players. This explains why silver can trade at seemingly moderate levels, even when physical supply is stressed. The reality is, retail hasn't even started to move in, and when they do, prices could surge dramatically. Another critical factor is the structural breakdown in Western pricing systems. Consider COMEX and LBMA inventories. Registered metal is declining rapidly, delivery delays are increasing, and spreads between spot and futures are widening. These are textbook signs of a supply-constrained market attempting to reprice itself. Server outages and delayed bar transfers aren't anomalies. They're signals that trust in the paper system is fading. Macro factors amplify this trend. The Fed's interest rate policies are reactive, not proactive. Real inflation is far higher than official reports, and the dollar is weakening against hard assets like gold, silver, and platinum. Central banks worldwide are divesting from treasuries and accumulating gold, signaling that confidence in fiat is dropping. The takeaway? Physical metals are no longer optional. They are strategic assets. Those accumulating now are positioning for long-term value and national security, not short-term speculation. These exchanges were never designed to supply massive amounts of physical metal. Their role has always been to set prices on paper contracts, assuming most participants would never demand actual delivery. That assumption worked for decades, but 2020 onwards, that changed. Now, huge entities are standing for delivery, tens of millions of ounces at a time. For context, in the December delivery cycle, COMEX saw nearly 2.4 million ounces of gold and 41.5 million ounces of silver stand for delivery. This is far above normal trading volumes, and the registered inventories are shrinking fast. Here's what that means for markets. Backwardation is emerging. Spot prices are higher than futures, signaling tight supply. Spreads are widening. Buyers pay more upfront because physical metal is scarce. System stress is visible. Server outages, delivery delays, and operational bottlenecks indicate the paper-based system is struggling to keep up. For investors, this creates volatility opportunities. Don't confuse these dips with market weakness. They're often engineered sell-offs or margin trigger cascades. The pattern is clear. Sharp dips are immediately bought by deep-pocketed players, reflecting a market trying to reprice itself against structural constraints. Now, let's tie in macro conditions. The Federal Reserve is cornered. A deeply inverted yield curve, exploding deficits, and a dollar losing credibility against hard assets limit its options. They cannot fight inflation aggressively without hurting the economy. Their strategy? Tolerate inflation, lower rates selectively, and support the system quietly. Why does this matter for gold and silver? Hard assets outperform financial assets when fiat confidence erodes. Real interest rates are effectively negative for savers holding dollars. Sovereigns and strategic industrial buyers are accumulating, while retail remains distracted by equities and AI hype. The net result? Structural demand is outpacing supply, and volatility is the market's natural mechanism to reprice metals against scarcity. Another key point is geopolitical signaling. The US recently classified silver as a critical mineral. China and India are controlling exports and using silver strategically. These moves are not symbolic. They are positioning for economic security. As an analyst, I can tell you this. The retail crowd doesn't see it yet, but when they start moving in, silver's price could spike dramatically. Even today, despite engineered sell-offs, silver recovers quickly because physical demand overwhelms paper manipulation. First, let's be clear. This isn't retail-driven momentum. Open interest in gold and silver is historically low. Hedge funds, speculators, and hot money aren't driving these massive delivery requests. The buyers are sovereigns, state-aligned industrial entities, and a few enormous private players. These are the actors with the resources to demand physical metal at scale, without concern for paper market manipulation. Case in point, a single entity or coordinated group stood for $2 billion worth of silver on COMEX. That's tens of millions of ounces moving in one go. Rumors trace this to Asia, potentially a sovereign wealth fund, industrial conglomerate, or private billionaire acting strategically. The goal is clear: secure real physical metal rather than paper contracts. This is significant because it exposes the structural fragility of Western price discovery systems. The COMEX outage during this delivery event wasn't minor. It lasted 12 hours, affecting only precious metal servers at one of the most pivotal times of the year. This is not coincidence. It's a clear signal that the system is under stress and scrutiny. Simultaneously, the LBMA in London extended bar transfer timelines from T+1 to T+8 weeks due to manpower and logistics shortages. Imagine your bank telling you, yes, you own your money, but pick it up in 2 months. That's exactly what's happening with gold and silver deliveries. the geopolitical and industrial signals further reinforce this shift. US reclassifying silver as a critical mineral. China reducing exports and controlling supply. India allowing silver as collateral, signaling strategic positioning. The pattern is unmistakable. Physical demand is being prioritized over paper trading, and the system is being forced to adjust. Now, from an analyst perspective, this creates opportunities and risk. Volatility will spike. Expect engineered sell-offs, short squeezes, and sudden price swings. But the underlying trend is clear. Scarcity and sovereign demand are driving a structural revaluation of gold and silver. For retail investors, the key takeaway is this. The market's true drivers are deep-pocketed, strategic, and informed. Following price charts alone won't reveal the whole story. Understanding delivery flows, physical shortages, and sovereign positioning is crucial to making informed decisions before retail participants flood in. The first point, historical ratios matter. For decades, silver to gold ratios hovered around 45 to 1, reflecting long-term geological availability and monetary value. Today, silver is mined at roughly a 7 to 1 ratio relative to gold, yet its market price is nowhere near reflecting this scarcity. That gap is a magnet for price correction. When supply is constrained and physical demand surges, historical averages act as a gravitational force, pulling prices toward fair value. Second, the West's paper systems are losing legitimacy. COMEX outages, evaporating inventories, LBMA delays, all signal a fracture in trust. When trust erodes, markets stop functioning efficiently. Money moves to jurisdictions and systems where price discovery reflects real deliverable metal, like Shanghai. This is not speculation, it's structural realignment. Third, sovereign and industrial actors are quietly accumulating, while retail is overlevered in equities and chasing hype like AI narratives. Massive flows of physical gold and silver are happening under the radar. If retail joins later, prices could spike dramatically, not because of momentum, but because supply is already tight and demand is strategic, not speculative. From a macro perspective, the Fed's stance is critical. They're tolerating inflation, lowering rates, and reflating through balance sheet support, while the dollar continues to weaken against real assets like gold, silver, and platinum. Government debt grows unchecked, and duration instruments fail to compete with tangible assets. In this environment, hard assets outperform financial assets consistently. Gold and silver are positioned to benefit. Volatility will persist. There will be engineered sell-offs, margin cascades, and headline-driven swings. But these are temporary blips. The long-term trend is driven by scarcity, sovereign accumulation, and structural flaws in Western pricing. So what should you, as an investor or observer, take away? Focus on physical flows. Track who is taking delivery and how much. Sovereign activity. Watch policy changes and export controls globally. Historical ratios. Silver is underpriced relative to gold and scarcity. Structural breakdowns. COMEX and LBMA disruptions signal real stress. Ultimately, the biggest opportunity is not speculative hype. It's understanding the structural dynamics. Markets are aligning toward a world where tangible metal, not paper promises, determines value. For gold and silver, the next chapter is less about charts and more about real-world supply and demand, geopolitical positioning, and systemic trust. That's the reality. That's the opportunity. And that's why we at Gold Rush Reporter focus on analysis that cuts through noise to show what's really happening under the surface. Stay vigilant, track the flows, understand the mechanics, and remember, the story in precious metals is just beginning.